Welcome to Illuminati Silver. We tell you the truth about silver. Today is Wednesday the 6th of May 2020, and yesterday we published a video entitled Gold and Silver Premiums Falling. We told you so, where we highlighted that today you can go out and buy, within certain limits, gold and silver, coins and in some cases bars, at considerably lower premiums than you could just a couple of weeks ago, which was something we predicted and advised our listeners not to indulge themselves in buying then, knowing full well what was likely to happen just a few weeks later. Then on Monday, we also published a video entitled End of Globalisation, Effect on Gold and Silver Prices, where we highlighted that the result of the coronavirus pandemic, any advancements in globalization are likely at best to be stalled and at worst to be retracted, depending, when we say at best and worst, whether you were in favour or against it. And on Sunday, we also published a video entitled The Truth About Gold Supply, Demand and Prices. And that one is a most interesting one too, perhaps unveiling some of the mystery surrounding why these prices have been so high of late. And we've placed links to all three of these in the description box below. Now today we're going to give a brief financial update, together with some economic news concerning the potential recovery in Europe, and how long it is likely to take once the lockdowns have been lifted. But first, let's take a brief look at how markets are performing. And as at 16:15 GMT plus 1, the time this is being written, most European markets are marginally in the black, but only just, with a slightly stronger showing in US markets, ranging from being up 0.26% in the case of the Dow at 23,944, trying to push through that 24,000 level, and up 1.25% in the case of the Nasdaq at 8,919, obviously with that 9,000 level in its sights. Oil prices are down around $1 a barrel today, with Brent crude standing at $29.70 and WTI crude at $23.52, considerably higher than they were a short time ago. Now the dollar index is also up and is now above that magical figure, if magical being the sort of figure it keeps trying to extend beyond, of 100, and is currently 100.08. Now gold has fallen back slightly after hovering earlier at the $1,700 level and is currently $1,687. And silver, which has hovered around $15, is currently $14.95. As we suggested in our Saturday weekly update, we're going to see a little consolidation of gold and silver prices, and quite frankly, we are not concerned at all about them standing at the levels that they currently do. Now, the ADP employment report declared earlier today that 20.2 million private sector jobs were lost in April. Small employers, those with 1 to 49 workers, culled 6 million jobs. Mid-size enterprises with 50 to 499 employees shed 5.3 million jobs. And large businesses with 500 employees or more have axed 8.9 million jobs. Now, more than 30 million people have applied for jobless benefits in the past 6 weeks, though not all of them are still unemployed. And another 3 million, it is estimated by MarketWatch, probably applied in the past week. Now, to give us a guide and a general overview as to what to expect in terms of recovery post the coronavirus crisis, an interesting article we shall now read to you was published by Bloomberg today. So here goes. Bloomberg article dated May 6th by Jana Randau. Recession deepens in Europe's south amid lockdown damage. Italy and Spain, the two European countries most severely hit by the coronavirus, are suffering even deeper slumps after record contractions in the first quarter. Lockdowns that shut hotels and restaurants meant companies experienced unprecedented declines in output and new orders in April, and cut jobs like never before in the history of IHS Markit's purchasing managers' surveys. Prospects for the next 12 months are equally dire, fueled by concerns that the many weeks of restrictions have inflicted long-term damage on the economy. The grim figures come after data showed January to March economic output fell about 5% in Italy and Spain, and only slightly less in the 19-nation Eurozone. The European Central Bank has warned GDP in the bloc could decline as much as 15% in the second quarter, telling governments, quote, joint and coordinated policy action, unquote, is needed to underpin an eventual recovery. National efforts have allowed companies to furlough more than 40 million workers, jobs that might have disappeared otherwise, and provided hundreds of billions of euros in loans, grants and credit guarantees. A meaningful solution to share the financial burden of those rescues around remains absent, though amid opposition from fiscally prudent countries including Germany, Austria and the Netherlands. In Italy, the euro area's third largest economy and also one of the region's most indebted, a PMI for services dropped to 10.8 in April. Spain saw its gauge slumping to 7.1, with hotels, restaurants and transport providers particularly badly affected. The political wear and tear is starting to show too, as the country's embattled leaders try to maintain control amid pressure to let people get back to work and tensions within their coalitions. Italian Prime Minister Giuseppe Conte is facing speculation about how long he can survive after he was forced to apologise for delays in delivering aid. In Madrid, Pedro Sanchez faces a vote in Parliament to extend his emergency powers Wednesday afternoon. While the Spanish Premier is likely to squeak through, the closeness of the vote shows the broad support he enjoyed in the early days of the lockdown has now evaporated. Observing the sheer scale of the drop in many survey indicators lays bare the impact that the pandemic is having on Spain's economy, said Paul Smith, IHS Markit's economic director. We estimate the economy is currently contracting at a quarterly rate of around 7%. With virus infections slowing, Spain and Italy have started to ease some lockdown rules. In the former, people were allowed to exercise outside last weekend for the first time in 7 weeks. In the latter, more than 4 million workers were cleared to return to work on Monday. Quote, with a gradual easing of restrictions planned to begin in early May, next month's data will give the first indication on how fast we can expect activity to recover in the short term, unquote, said Lewis Cooper, an economist at the London-based firm. Even in the best scenario, rebuilding the economy will take time. The International Monetary Fund predicts a euro area slump of 7.5% this year, followed by growth of 4.7% and 1.4% in the subsequent 2 years. End of article. The chairman of Standard Chartered Bank has given an interesting perspective of recovery by suggesting that it's likely to be driven in Asia. Not America or Europe, but in Asia. So let's take a brief look at a Reuters article where he has quoted this. Reuters article dated May 6, 2020. Headline: Standard Chartered chairman predicts economic recovery led by Asia in late 2020. Standard Chartered chairman Jose Vinales said on Wednesday his Asia-focused bank was well placed to benefit from a late 2020 economic rally, despite the extraordinary impact of the COVID-19 pandemic on the global economy. Quote, there is no doubt that the world will be coping with the threat of COVID-19 for some time. We expect most economies to suffer significant negative growth rates this year before the global economy moves gradually out of recession, starting in the latter part of 2020, unquote, Wienals said via a video message to investors posted on the bank's website. This recovery will most likely be led and then driven by markets in Asia, where we generated 80% of our profits in 2019. The bank's annual investor meeting was close to shareholders in line with government restrictions to control the spread of the new coronavirus. Results of proxy voting in the AGM will be published to investors later on Wednesday. The Spanish economist, who has served as chairman of the bank since December 2016, also said the board had acted decisively to cut pension perks for executives after a sizable investor rebellion last year. End of article. An interesting view, and perhaps not one that either Americans or Western economies necessarily wish to hear. The economic data published by the US yesterday, on top of today's unemployment figures or jobless claims figures, highlights the difficulties the US economy is facing. So let's look at an article published yesterday by Reuters on this very issue. Reuters article dated May 5th, 2020. US trade deficit widens, services sector contracts amid coronavirus. The US trade deficit increased by the most in more than a year in March as a record drop in exports offset a shrinking import bill, suggesting the coronavirus outbreak was upending the global flow of goods and services. Other data on Tuesday showed the tough measures to slow the spread of COVID-19. The respiratory illness caused by the coronavirus pushed the nation's vast services sector into contraction in April for the first time in nearly 10.5 years. The reports were the latest indication that the economy was sinking deeper into recession and that a sharp rebound was unlikely even as parts of the United States started to open. Quote, trade between lockdown countries all over the globe will continue to falter in what looks like a second Great Depression, and it could be years before the globalisation trend reasserts itself as the world grows more cautious during this unprecedented health crisis, unquote, said Chris Rupke, chief economist at MUFG in New York. The Commerce Department said the trade deficit jumped 11.6%, the largest rise since December 2018 to $44.4 billion. Economists polled by Reuters had forecast the trade gap increasing to $44 billion in March. Global lockdowns have severely disrupted supply chains and also weighed on demand for goods and services, shrinking economic output. In the United States, gross domestic product declined at a 4.8% annualized rate in the first quarter, the steepest pace of contraction in output since the fourth quarter of 2008. Economists believe the economy entered recession in the second half of March when the social distancing measures took effect. The National Bureau of Economic Research, the private research institute regarded as the arbiter of US recessions, does not define a recession as 2 consecutive quarters of decline in real GDP, as is the rule of thumb in many countries. Instead, it looks for a drop in activity, spread across the economy and lasting more than a few months. Though some parts of the country have started reopening, economists did not see the economy quickly returning to pre-pandemic levels, which they said would take years. Reopening the economy also involves the risk of a second wave of infections and further lockdowns. A survey on Tuesday from the Institute for Supply Management showed its non-manufacturing activity index fell to a reading of 41.8 last month, the first contraction since December 2009. It was also the lowest level since March 2009 and followed a reading of 52.5. In March. A reading below 50 indicates contraction in the services sector, which accounts for more than 2/3 of US economic activity. The ISM survey measure of new orders for the services industry dropped to a record low in April. Quote, "We continue to expect that the apex of the impact of COVID-19 on the US economy occurs this quarter, with GDP falling around 30% at an annualized rate," unquote, said Ryan Sweet, a senior economist at Moody's Analytics in Westchester, Pennsylvania. Stocks on Wall Street were trading higher as investors ignored the data, focusing instead on recovering oil prices and an easing of travel restrictions in several countries. The dollar rose against a basket of currencies, and US Treasury prices were mostly lower. End of article. So we can see not a pretty picture. And if the economists, as published in this article, are right, then President Trump's recent comments suggesting that the US economy will bounce back significantly towards the end of this year and into 2021, where I think he actually mentioned the words unprecedented growth, appears, from this at least, to be rather over-optimistic. What do you think? Do share your thoughts. Thank you so much for listening, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published. Not forgetting that we update our Richard and Greg channel every few days, and we published a video on that yesterday. So if, again, you haven't done so, please subscribe to that one too. Links to all of these are placed in the description box below. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.